All right, welcome everyone. Welcome to today's episode of Market Wrap. I have with me Mr. Pankaj Pandey, and what a week it has been. 1.5% up, sir. Good greens for the portfolios. What has happened and what's likely to happen from here on?
Hi, good evening, Vishu. Yes, this is the second consecutive week. Markets have extended gains, and this is largely to do with the fact that US has softened its stand on the tariff, and which has sort of lifted the overall sentiments on the market. And as a result of that, this week we have seen Nifty sort of rallying about 1.5% to 25,100 kind of levels. Even beaten down sectors like IT, defense, PSU banks, I think all of them witnessed good rebound. While sectors like, say, consumer discretionary, which were sort of doing well, have taken a breather. And also, I think what we are seeing is in the US market is that the US job data is sort of softening and inflation is sort of going up, and that is sort of putting a case for a 25 bips kind of a rate cut. Even some people are speculating a 50 bips kind of a rate cut, which can happen next week. So all this is sort of leading to a risk on rally in the markets, and we are sort of a beneficiary of it. And I think any incremental news flow on the tariff front is going to be a big positive for us because post GST cut, I think tariff was something which was holding the market from rallying. And I think those concerns are now sort of getting addressed. So I'll not be surprised if we see 3 to 5% kind of move once this trade deal sort of happens. And overall sense is that when you look at two of the biggest sectors, which is your bank or BFSI plus IT, all these two sectors contribute nearly 45% of the Nifty. And both have been impacted because of US actions. IT again is witnessing a challenging outlook because the US outlook is not clear. Banking is witnessing, has started to again witness selling from the FIIs. So from that perspective, a relief can happen for both these sectors, and these are heavyweight sectors. And if these sectors tend to perform, then 3 to 5% kind of a move, and even possibly more higher kind of a move is very much possible. And which is why I would want to believe that 25,800 is very much possibility in the coming months. And I think on the support side, 24,400 looks as a strong support for the market. And I think that is going to probably any incremental positiveness or positivity coming from this tariff deal is going to sort of things will make markets better going forward. So I think US doing a U-turn is turning out or is lifting the markets.
Absolutely. And so, what do you think about the domestic flows? How have the recent times been?
So, Vishu, a lot of things were said that if the market returns are zero or negative, inflows will dry up. But what we have seen is absolute contrary to that. Last 1 year, Nifty returns are flat or zero. Small cap index is down about 6% odd. But when you look at these inflows are still pretty robust despite this fact. And when you look at the absolute numbers, it looks lower at about 33,000 odd crores for August month compared to 42,000 odd crores what we had got in the month of a month before. I think we need to sort of strip out the NFOs of 9,000 odd crores, which happened last month. This month, there were about 2,100 crore worth of NFOs. So if we sort of strip that out, August month has seen the one of the highest inflows. So it is the fourth highest inflow what we have seen. I think so. From that perspective, I think things are pretty good for the markets. And even just to sort of highlight, small cap index is down about 6% odd. But when you look at all the categories, those have seen pretty good flows. So, for example, large caps have seen an inflow of about 2,800 odd crores compared to 21. Sectoral funds are witnessing some bit of a revival, 2,500 crore kind of inflow compared to 2,000. I think Flexi Cap, which is the flagship category because they can invest in large cap, mid cap, or small cap, or they can toggle across caps. So there the inflows are pretty stable at about 7,600. Now, when you look at small cap and mid cap, marginally lower, so from 5,400 crore to 5,000 odd crores, or mid cap at 4,700 crores compared to 5,200 crores. So your all the categories are seeing pretty robust flows. And I think in case of, like I said, if FIs were to sort of come back in the market, then new highs are very much in the cards. And I think SIP numbers are quite stable at 28,200 odd crores. So domestic inflows are pretty stable and robust. I think once the FIs are back in the market, things are going to become a lot more better for the markets before the actual data sort of flows in or the actual numbers start to improve.
Sir, I think last time also we discussed auto sector and it was one of our sectoral picks. It had already started showing some signs as well. But the rally has not kind of stopped. So could we delve a little deeper into what is happening in the auto sector?
So Vishu, auto was one of the sectors which was expected to sort of benefit the maximum because except for two-wheelers above 350 cc and above, the overall taxation has come down across categories. And we are not surprised that this sector has rallied about 13% in the last 1 month, outperforming Nifty significantly. And this index trades at a near high. And our sense is that when we look at this week, most of the players have announced price cuts, and those price cuts are quite sort of significant. And our sense is that this policy-led affordability boost is definitely going to lift the industry volume by 8 to 10 odd percent. And we can go category-wise. So, for example, entry-level vehicles, four-wheelers, models like Alto, Wagoner. I think all of them have are witnessing a price cut of 40 to 70,000 odd. Similarly, you look at compact SUVs, there the price cut is in the range of 1 to 1.5 lakh, or even the other categories 8 to 10, 80 to 10, 1 lakh is the kind of a price decline what we have seen. Two-wheelers, we are seeing a price decline of say 7 to 15,000 odd. So for I think highest decline is what we are seeing is about 22,000 odd for 350 cc models. And so two-wheelers are also witnessing a good amount of price decline. CVs, in some cases, the price decline is about 6 lakh rupees. So all in, and will not be surprised if the overall CV volumes touches a new high this year or surpasses the previous high. And I think what it has also done is that when you look at the market composition, the unorganized or the secondary market or the used car market is about 1.3 times bigger than the new car sales market. And with this kind of a price decline, our sense is that a lot of used car buyers will be tempted to head towards a new car. And that again is going to sort of lift the overall volumes. And I think our overall sense is that this is not the only thing which is going to benefit next year. It is very much possible that we'll have 8-way commission benefits are kicking in. And with US Fed cutting rates, it is, and with inflation lower for us, crude also is softer. We could witness further rate cuts as well. So that again also is going to sort of boost the auto sector. So further gains are ahead in the auto sector. That is what I would say.
Sir, I believe there's an interesting study on how FMCG companies maybe face some, if I may, small problems with the new GST rate cut. If you could explain us that.
So yes, Vishu, FMCG companies are in a sort of a catch-22 kind of a situation. See, the challenge is that their 40 to 45% of their overall volumes happen with smaller packs, which are priced at 5 to 10 rupees. Now, for bigger pack, things are very clear that they need to sort of put a sticker besides the previous MRP and stating that the revised prices are this. So that's a easier segment to sort of tackle. The challenge is with the smaller ticket size segment, since it's a volume contributing segment. Now, if they have to sort of pass it on, a 5 rupee pack prices could come down to about say 4.7. Now, from a transactional perspective, it becomes challenging to for someone to sort of transact it at 4.7 rupees. And which is where the challenge lies, because you can't really increase the grammage also because existing inventory needs to be sort of consumed in the system. And in case if they choose not to do anything, then it will imply that they have not really passed on the benefits of GST cut. So I think yes, things are tricky for them. At best, what they can request, or they are requesting the government to sort of extend the deadline by 45 to 60 odd days, so that this inventory sort of gets consumed. But there's no direct answer for this, how this situation is going to sort of get tackled, because overall sense is that this 5 to 10 rupee is a trial pack for FMCG companies for any of the new product launches. So I think this price point is here to stay for them. And grammage is what they can maneuver for newer lot, but existing, which is there in the system, really do not have an answer. And I think they're still also grappling and probably looking for directions from the government.
Right, right. So, switching topics, the talking about the tariffs, US tariffs. Could you tell us what is the ground reality? How are companies tackling these tariffs?
So, Vishu, I think what I would want to highlight is that, see, textile is one of the sector which is witnessing the maximum impact. We export about $10 billion worth of textile to US, and the sector is facing about 50% tariff now. So I think some insights what I can sort of share from the recent management interaction of Gokaldas Export, which is an exporter, is that the company expects that the US deal will happen, and I think we also concur with that. And they're expecting that the penalized tariff of 25% will come down, so from 50% to 25%. And what the company has done is that for whatever export they are sort of doing after August 27, so they are offering discounts. Their clear strategy for them is to sort of not to sort of lose the client to any other country which has got lower tariff. And I think in case of this 50% tariff stays, then in the Q3 quarter, overall sense is that for a company of like this, of Gokulas, which used to sort of deliver margins of 10 to 11 odd percent, the margin erosion is going to be significant to the tune of 600 to 700 odd bips. So which means that margins could come down to 3 to 4 odd percent, and it is possible that they could be staring at losses as well. There are some things which they are also working. One, they are looking to sort of diversify to newer locations. So, for example, Africa is one of the locations there. The US tariff is 10 odd percent. They're also looking to sort of venture into other markets like, say, Bangladesh or Sri Lanka, which attract or where the tariffs are 20 odd percent, to mitigate this impact. And then I think diversification is also the answer, because one UK market or UK imports about $1 billion worth of Indian garments. That number can easily develop to about $2 odd billion given the FTA what we have signed with them. And EU sort of imports somewhere about $2 billion with us. EU imports somewhere about $5 billion, and it is possible that they can import $2 billion additional. And we are already talking to EU for a deal. So, company is working on multiple things to sort of improve the scenario. But near-term margin pressure is very much expected. Don't be surprised if a company makes a loss in Q3. But what the company is also saying is that FY 27-28 onwards, once the deal happens, revenue can grow in strong double digits, and we've seen this stock correcting by about 25 odd percent. So any kind of incremental positive can lead to a re-rating of the stock. We are also in a wait and watch situation, and which is why we have put a rating of hold on the stock. But overall sense is that companies are looking to mitigate, but yes, 50% becoming 25 will be a big help.
Right, right, sir. Another news this week was big news this week was Infosys and its big buyback. What are our takeaways from this?
Yes, so IT as a sector has not been doing well. Infosys in particular has been particularly sort of weak. What they've given a guidance is 1 to 3 odd percent, which is really not exciting for the markets. In the midst of this, company has announced a buyback of 18,000 odd crores. This is one of the biggest buyback we have seen. I think 2017, the buyback amount was somewhere about 13,000 odd crores, and prior buybacks were under 10,000 odd crores. What this is going to do is that it is going to incrementally improve the EPS by about 2 odd percent. ROEs will jump from say 27 to 28.5%. Now, definitely, this is going to improve the overall sentiment and will support stock prices. But I think one of the still core challenges for the IT sector is when you sort of do a comparison with what is happening to their peers in the US. US tech giants are making new highs. We've seen companies like Oracle doing very well. What they have been able to do is that they are delivering non-linear revenue growth driven by AI, whereas Indian companies are still unable to sort of decouple themselves from the cost. So leaving them pretty much reliant on similar traditional margin levers. And Infosys, for example, is down about 24 odd percent. So, and our sense is that while it will lift or it might improve the overall sentiment in the stock, it is very much possible that Infosys peers like TCS, Wipro also might come up with a buyback because TCS has got a cash reserve of about 8,300 odd crores, and they have a policy of distributing 80 to 100% of their free cash flows. Wipro has about 12,000 odd crores, and they have adopted a policy of returning 70% or more of net income over the past 3 years. So there also it can happen. But for any structural improvement, I think this AI-related benefit and this decoupling of or non-linearity of revenue and cost, I think that needs to sort of happen. So near term, yes, it is going to improve the sentiments and support stock prices. But yes, for structural improvement, I think more ground needs to be covered.
Right. Sir, there's also talk of consolidation in the markets right now, consolidation of PSBs, public sector banks in the market. What do you think is happening there?
Oh, yes. So I think government is very clear that they would want a lot of banks or Indian banks in the top 100 list. So which is why they are actively pursuing the consolidation of PSU banks. The purpose is to create larger, stronger banks which are globally competitive. And the strategy is to improve the operational efficiency and boost their global competitiveness. We had round one of consolidation happened in 2020 when the state number of state-run banks were reduced to 12. At that point of time, we had seen merger of Oriental Bank of Commerce and United Bank of India with Punjab National Bank, Syndicate Bank and Canara Bank got merged. Then merger of Andhra Bank and Corporation Bank into Union Bank of India happened, and then Allahabad Bank merged into Indian Bank. Now, overall sense is that this time also something similar will happen. Government will look at further consolidation and look at the geographical spread. And I think our sense is that among the contenders, you'll have weaker players or smaller players like say UCO Bank, Bank of Maharashtra, Punjab and Sindh Bank, and Central Bank. I think these are the potential candidates for consolidation. One thing I would want to sort of highlight is that, see, last time when we had this round of consolidation, we had seen a very sharp rally in the public sector banks. One, because the government had infused money and amid the elevated asset quality concerns. But this time, asset quality, profitability, I think is pretty much okay across PSU banks. There's nothing much to complain. Valuation-wise, are also they are relatively attractive, but not the kind of headroom which they were carrying earlier. Our sense is this time the performance is going to be selective. It's not going to be a broad-based public sector bank rally unless something more detailed sort of come out. But yes, better days ahead for PSU banks. Which ones still going?
Right. While we're on finance, what is the outlook on microfinance institutions right now?
So Vishu, when you look at the price performance of some of these MFI companies, a lot of these companies have taken a significant amount of beating. And in fact, when you sort of look at the small cap index earning growth, MFI has been contributing to the overall lower growth of this particular segment. Now, microfinance overall AUM has seen a contraction to about 3.6 lakh crore. So it's a decline of 17 odd percent as on June 2025. Now, the number of active accounts have also declined from nearly 16 lakh crore, 16 crore to about 13 odd crore. The unique client base has also sort of shrunk. NBFCs, which have been promoting MFIs, there also the disbursements have declined by 25 odd percent. The sector was in a sort of a bigger mess, but I think things are improving, and our sense is that when you look at all these headwinds are sort of behind us. Because one would have find because of subdued growth plus rising asset quality concerns, the portfolio at risk had spiked to about 12 odd percent. Now, when you sort of look at things are improving, the collection efficiency has improved. In fact, the delinquency in the early or mid stage is also sort of coming down from 3% to 2 or 2.4 odd percent in the last 6-7 odd months. The payment discipline has improved. Companies like Ujjivan have recently highlighted that the collections have improved to 99 odd percent. Then there is a revival in disbursement is what they are seeing, and overall sense is that most of the tailwinds are getting supportive for the sector and for the credit flow to sort of normalize in the second half. And I think we don't have a big coverage on there, but we cover the best company, which is Credit Access Grameen. I think this is one of the few companies which has got pretty good, has got a good diversified spread across states. And I think this company has got scale advantages, and then they have a proven record on the underwriting side, and which is why we feel that this is one of the stocks to sort of play that opportunity with a target price of 1450.
Right, sir. And finally, this is now time for hidden gem of the week. Which will it be this time?
Vishu, I think with US India things sort of normalizing, and with even defense minister highlighting that defense is not going to be impacted, I think defense stocks have started to sort of buzz again. So which is why I would want to recommend a stock called Premier Explosives. Here our target price is 680. Now this company is a leading manufacturer of high energy materials like propellants, countermeasures for defense, and bulk explosive, which are used in the mining and the infrastructure segment. The company has got 6 manufacturing facilities, largely for bulk explosive, only 2 are for propellants. Propellants are used in a number of places. It is used in missiles, it is used in rockets, and flares and shafts are used as countermeasures. So basically, to sort of decoy or misguide missiles. So this company is very well placed there. They've got an order this year. They've got order inflows of about 700 odd crore. The order book is 1100 odd crore, which is about 2.5 or 2.4 times of the trailing 12-month revenues. And I think overall sense is that the company has guided for about 600 crore kind of revenues. So which means that about 44% kind of a growth, because last year their top line was about 417 odd crore. And their gross block is about 250 odd crores. They're doing a capital expenditure of about 25 odd crores. In the next 8 to 10 years, the management is guiding for a capital expenditure of 800 odd crores, which is multiple times of their current gross block. And our sense is that this company can deliver good growth of say 27% in terms of top line. Bottom line growth could be even more higher at 50 odd percent. So I think with good growth, we feel that this stock has the potential to do well, and it's trading at relatively attractive valuations of 28 times on FI28 basis. So which is why we feel that this stock is a good buy at current levels.
Right. Well, that was it for this time. Thank you so much, Pankaj sir, for those insights. And thank you so much, everyone, for watching. We'll be back next week. Until then, if you have any questions, please put them down in the comments and we'll try to get back to you. Thanks again.
Thank you so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.